It's a common assumption that contract for difference, or CFDs, futures and spot trading are all interchangeable terms, representing the same investment strategies. But this couldn't be further from the truth. Each of these financial instruments has its unique features and uses, and understanding their differences is key to mastering the art of trading. So buckle up, folks, because today, we're about to clear the fog surrounding these three types of trading. Let's start with CFDs, or contract for difference. This financial instrument allows traders to profit from price movements without actually owning the underlying asset. It's a contract between a trader and a broker, where the trader can speculate on the rising or falling prices of fast-moving global financial markets, such as Forex, indices, commodities, shares, and treasuries. The profit or loss in CFDs is determined by the difference between the buy and sell price. Now, on to futures. Futures are standardized contracts to buy or sell a particular asset at a predetermined price at a specific future date. Unlike CFDs, futures contracts are traded on regulated exchanges and are legally binding agreements. This means that the parties involved are obligated to fulfill the terms of the contract. Futures are commonly used for hedging risk or for speculation. Now let's talk about spot trading. Spot trading in its simplest form is buying or selling a commodity for immediate delivery and payment on the spot. This is typically 2 business days from the trade date. The main difference between spot and futures trading is the actual delivery of the asset. In spot trading, the transaction is settled on the spot, while futures contracts are settled at a future date. So, to recap, CFDs allow you to speculate on price movements without owning the asset, futures are contracts to buy or sell at a future date, and spot trading involves immediate delivery and payment. It's important to remember that each of these trading types has its own risks and rewards. CFDs offer flexibility and leverage, but they also come with a high level of risk due to market volatility. Futures, while providing a hedge against price fluctuations, carry the risk of potential losses if the market doesn't move in the anticipated direction. And with spot trading, the risk lies in the asset's price fluctuation between the trade date and the settlement date. Understanding these differences is essential for any trader looking to diversify their portfolio. It helps you choose the right tool for your trading goals, whether it's short-term speculation or hedging against future price movements. So there you have it. CFDs, futures and spot trading, each with their unique features and uses, each a powerful tool in the world of trading. Remember, knowledge is power, especially in the fast-paced world of financial markets. If you found this information helpful, show some love by hitting that like button. Share this video with those who might benefit from it. And don't forget to subscribe for more clear, concise, and informative videos on trading. Stay smart, stay informed.